Most major financial markets remain closed for the holiday. Economic analysts at Financial Derivatives see lower oil revenue and a growing deficit erode the fiscal consolidation policies of the Nigerian government in 2019. Plus, we will take a look at how African entrepreneurs maneuvered the business environment in 2018. Thank you for joining us on Business Incorporated. I'm Chimezie Obi Iwagu. We get started with the markets, and here on the African continent, the Nigerian stock market and the JSE index in South Africa remain closed for the Christmas holiday. Well, the Nigerian stock market rallied heavily on Monday, up almost 4%. The South African JSE index was also up 1.27% on Christmas Eve. However, at intraday today, Egypt was up 1.7%. Kenya also closed positive ahead of Christmas. In the Middle East, markets were more on the positive side at intraday, except Qatar, which came down 0.11%. Abu Dhabi was up 0.34%, Dubai up 0.06%, and Saudi up marginally 0.02%. And markets in Europe are still closed. However, Monday shares closed lower following a session of heavy selling stateside last week. The FTSE 100 closed down 0.6% during a shortened session before the Christmas holidays, while the French CAC 40 slipped 1.5%. Germany's DAX and the Italian FTSE MB were not open on Monday. In corporate news, BMW was hit by South Korean government with a 11.2 billion won fine on Monday and faces a complaint over allegedly delaying recalls and concealing defects that resulted in engine fires in the country. Market players are mostly focused on lingering fears of a slowdown in global economic growth. The Federal Reserve last week raised interest rates for a fourth time this year at its latest monetary policy meeting, as was expected. But the U.S. Central Bank was less dovish than many traders had anticipated. Some are worried it may be tightening policy too fast. Meanwhile, political drama stateside will be another area of focus for traders, with the government facing a partial shutdown that is likely to last until at least December 27. And in Asia, Japanese stocks saw gains today following a Christmas Day plunge of both the Nikkei 225 and Topix. The Nikkei 225 gained 0.89% to close higher at 19,327 points, while the Topix index saw gains of 1.12%. Over in South Korea, the Kospi slipped 1.31% to close at 2,028.01, as shares of industry heavyweight Samsung Electronics shared 1.16%. The mainland Chinese markets, watched in relation to the trade spat between Beijing and Washington, slipped on the day. The Shanghai Composite fell around 0.26% to close at about 2,498.29. The Shenzhen Composite also slipped 0.42%. The markets in Australia and Hong Kong are closed today for a public holiday. And in U.S., stock futures pushed higher on Wednesday as Wall Street ready to reopen after a shortened pre-Christmas trading session that turned out to be the worst in the history of the stock market. The rest of the week will see normal trading days after Monday's early close for Christmas Day and Tuesday's full closure. After cross back and forth across the flat line, Dow Jones Industrial Average Futures rose 108 points, while S&P 500 Futures rose 12.55 points, and Nasdaq 100 Futures rose 24.25 points. Another negative session Wednesday would mark 5 straight losing sessions, and last week marked the worst week of trading since the 2008 financial crisis. The Nasdaq officially entered bear market territory on Friday and is now off 23.6 from its record close set August 29. The S&P is down 19.8% from its September 20 record close, and the Dow has slid 18.8% from its October 3 record close. With many traders out for the holidays, volumes are expected to be thinner and moves could be exaggerated. Well, let's look at the global oil market there. Prices were mixed in thin trading today as the U.S. benchmark rebounded from steep losses in the previous session, even though concerns over the health of the global economy continued to overshadow the market in the longer term. U.S. West Texas Intermediate crude futures were up 29 cents at $42.82 per barrel early today. having at one point risen as high as 2.2% from the last close. They had slumped 6.7% in the previous session to $42.53 a barrel, the lowest since June 2017. Meanwhile, Brent crude oil futures were down 11 cents at $50.36 a barrel, having skidded 6.2% in the previous session to $50.47 a barrel, the weakest since August 2017. And to metals market, gold prices hit a 6-month high today as concerns over global growth and a partial government shutdown in the United States fueled risk aversion, prompting investors to seek refuge in the metal. Spot gold climbed 0.3% to $1,271 per ounce. The metal hit $1,272 in early trade, its highest since June 20. U.S. gold futures were up 0.3% at $1,275.8 per ounce. Investors are uneasy about global economic growth and are seeking gold as a safe haven. Among other metals, silver rose 0.5% to $14.80 per ounce, while platinum rose 0.3% to $784.50. Palladium was up 0.5% to $1,252 per ounce. And away from the markets and back here as 2018 gradually winds down, many economic analysts are beginning to forecast economic trend in Nigeria in the new year. Economic think tank at financial derivatives company say the Nigerian economy may succumb to pressures of an oil price down by 40% to $53 per barrel range and a cut in production to 1.67 million barrels per day. The lower oil revenue and a growing deficit will erode the fiscal consolidation policies of the government. According to them, with banking industry fragility and a naira under speculative pressure, 2019 will be a year of technological and investment opportunities, but serious political and policy challenges. And as general elections approach, the analysts are anticipating voter apathy and a low turnout in the February election. Meanwhile, a former Central Bank Deputy Governor, Mr. Tunde Lemo, says raw GDP numbers will not deliver well-being to 180 million Nigerians. Speaking on our Business Morning program today, Mr. Lemo emphasized on the need for policymakers to rethink and redirect policies and investments at job creation and inclusive growth.
It's been made very, very clear that raw GDP numbers may not be the best barometer to see growth, particularly if you're looking at a densely populated country like Nigeria. The Human Development Index actually did prove that just raw growth in Nigeria may not deliver what we expect that people will have in terms of well-being. And that is why we began to look at employment-generating growth. And unfortunately, because of the structure of our economy, Nigerian economy, even though oil and gas is less than 10%, has been providing the bulk of the growth, and most of this is externalized. The people on the street don't feel the impact. So today, it's important that policymakers should actually redirect our efforts at creating jobs. And this then means that we need to invest in job-friendly activities, activities that will actually mean that we'll begin to attack the unemployment figures, and then that is where you can directly see the impact on the well-being of the people.
But the big numbers do matter, don't they?
Of course they do.
The big numbers.
They do, but provided, of course, the numbers also would cascade to delivering well-being of the people. If you just look at the big numbers, for instance, in Nigeria, the Gini coefficient actually tells us that most of these big numbers go to the big boys. So when a billionaire makes additional billions and trillions, that does not actually help economic development. It doesn't help the man on the street. It doesn't deliver social values. And so, yes, big numbers on the one hand, but on the other hand is how is this big number distributed? What are the activities that actually engage people in terms of productivity and employment? US, for instance, tackles this every time they track employment job increases, which is why you see those numbers roll out. Every month, US will celebrate, additional 20,000, additional 100,000 jobs are created because they understand this impact.
Those jobs are created by the private sector or by the government?
Of course, U.S. is a private sector-led economy, so most of these jobs are created by the private sector. But of course, the government provides the enabling environment, and I think Nigeria should learn from this. Nigeria should not just think that the president will throw money at unemployment and then jobs will be there. No, nobody expects government to provide jobs. That, of course, is even the former socialist economists have since discarded that. But government should provide the enabling environment for private sector to create jobs.
How do we do this? How do we transit from what we've done for nearly 60 years of a public service-led economy to a private sector-led economy? How do we unlink this and lock in the private sector in there as the engine for this inclusive growth? It looks like a very difficult thing to do.
It's not difficult, Bosin. The journey actually has started. If you look at the way we transited from 1999 up until 2007, we began to make progress in the sense that the government began to free up resources into the private sector. Look at what happens in telecoms. Look at what happens in so many other sectors. Private sector, most of these assets that were not well utilized by the government business concerns were privatized. And then through privatization, you look at the revolution that has happened in cement. We thought before, you heard of Cement Armada when we were importing cement into the country. But today, the major cement producer in Nigeria has become major cement producer for Africa. And the same thing can be replicated. All the government needs to do is to provide infrastructure. The major constraint to the private sector delivering this employment number is because of decaying infrastructure that we have seen year on year. Today, for instance, the global economy is estimated to spend about 20 trillion on infrastructure this year, which is approximately 20% of GDP. But today, Mr. President just gave us the budget and $6.22 billion capital expenditure, which may not necessarily be infrastructure. But let's assume that is a proxy for infrastructure. That is less than 2% of our GDP. And so we're really not dealing with infrastructure as seriously as we should.
But the current administration is doing some roads and rail. And do you think maybe in 2, 3, 4 years down the line, we will begin to see the private sector benefit from these investments?
Well, you're right. The current administration has been trying. In fairness, in the last 3 years, so much has gone into roads and rail. But at the end of the day, when you sum it up, it's just a tip of the iceberg. We need a lot more investment. Today, we're still talking about Kano-Kaduna rail and so on and so forth. Imagine the entire Nigeria 774 local government. All we need to do is create that environment whereby every naira that the public sector puts into road or rail infrastructure, that can attract another 99 naira from the private sector.
How do we make that happen? How do we make that happen? Policies, action, what? MOUs?
Policies, MOUs, PPP. PPP models, there are different models all over the country, all over the world. I like the model in Brazil. Brazil has actually used PPP to develop infrastructure, particularly during the administration of President Lula. And today, when you look at the infrastructure revolution in Brazil, it's all been powered by private sector majorly. But government will provide the enabling environment. Look at the experiment we wanted to do, the Lekki second toll gate. For one reason or the other, there was a rollback. Maybe it wasn't well thought out. But at the end of the day, if we do it well, there are so many major roads that we can privatize in Nigeria. When you provide global capital, you quickly transform infrastructure, and that is when you can then get Nigerian manufacturing concerns to be globally competitive. Today, everybody produces for the global market. If you are not competitive, then of course, not just that you will not be able to meet the local consumption, even those who produce better, those who are more efficient in other climes, will bombard your market with cheaper goods. About 20, 30 years ago, there were over 127 textile companies in Nigeria, from China, from India. Where are they today? They've all gone back to their climes. In those days, Nigeria was a better country to produce in terms of infrastructure.
Tunde Lemo, former Deputy Governor of the Central Bank of Nigeria. We'll take a quick break, and when we come back, of course, as part of our Africa Economy Review, we will look at how entrepreneurs maneuvered the business environment in 2018. Do stay with us.